Okay, hi everybody. Welcome back to Hurdle Rate. Today we're going to build out the DCF model for Costco. We've already done the WACC and the cost of equity if you watched the previous video. So yeah, here we have it, a bit of housekeeping. Make sure that we include other international in the same segment for US and Canada so that we can get the correct weighting. And we should have the equity risk premium as being 4.69 on this. But let me just update the risk-free rate as well, because that has changed. 4.051%. So let's see what this comes out as. 4.051. 8.18. Yeah, so it does slightly change the WACC, which we have here. And what are we going to build? We're going to build a DCF model where we break down Costco's revenue, forecast them out for the next 5 years, and then we'll look at the EBIT, the taxes. We're going to add net income here as well because we might want to do some multiples analysis at the end. We've got the cash flow items, the depreciation and amortization, the capital expenditures, and the change in net working capital. What we're going to do, is put it all together, and we will get the forecasted free cash flow, discount that back to the present day so we can get a value for the company. And yeah, just without further ado, let's get started. First thing we're going to do is open a new page. So yeah, insert another column. Well, first of all, freeze the first pane. You go view and you say freeze first column, then insert another column, make the A smaller and the B larger. And in A1, we put cost, with that being Costco's ticker, and we can say data, come back, we go stocks. And you don't need to go back onto this page yet, that's it. Costco Wholesale Corporation. And the first thing we do is we go ticker, we go date, we have current price, implied, and then we have our up, down. And the ticker is equals A1 dot, what did I say, ticker. Then the date, today is the 10th of September, 2025. And the current price equals A1. And the implied, we can leave that for now. Then we want to put an X here. And I like to use this sort of darkish blue, but the font is white. And we call it assumptions. As well, let's just put a bit of a border and then no fill. We want this color, we want the border just like that. And we take here and we go boom, sorted. So assumptions, we're going to say segment, and this is going to be the revenue segments for Costco, of which I have down here. So Costco breaks into 4 in terms of their product sales, and then you have another for membership. So we say switches, then we have bear, base, and bull. And we take this formatting, and how many do we need? 5. 1, 2, 3, 4, 5. There we go. So the first one, non-foods, fresh foods, warehouse, and other. We also have memberships. Just put a 2 in these to keep it on the base. Then we have the EBIT, WACC, terminal growth value, then sorry, I don't have to do. There we go. And the first thing we do is the revenue build. We're going to start in 2022. And always make the title of the revenue segment equal to what is in the assumptions, so that if you update it in the assumptions, it's going to update below as well. Then we can keep bringing this. We call that B11. Oh, sorry. There we go. That's better. Let me zoom out a bit. And then at the bottom down here, we just have our, it needs to go to there. Put a order to show it separates. And we go total revenue. Sorry, you guys can't see, my bad. Put a border here, and we go total revenue. Now let's start filling this in. So for the first, we can see that for foods and sundries, 85629. So you always have to make sure that you're reading them the right way. You have to start 2022, 23, 24. Yeah, sometimes it's easy to get mixed up on the order. Seems to be number 85629. Then we have 96175. 463. To get the percentage growth, you take the latest year divided by the, well, you take the year divided by the previous year minus 1, and you just have to format it into a percentage. You can just copy it over, and then it will automatically adjust for the correct numbers. Non-foods now. So non-foods in 22 is 61 billion. In this, well, 2023, it's slightly down, 6865, then 63973. Then fresh foods, 29527. 31977. Then we come to warehouse. 46474. 48693. 49,969 for 2024. Then memberships is actually further up on the original income statement. Let's pull it up. Where is it? 2025, we only have partial results, but Costco reports on the 25th of September, I think. So what we'll do is we'll just do sort of projections for the full year. And then when those earnings are released, we'll just update and we'll do a short video on it. Okay, so membership fees here. 4224. $4,580. Let's just do the total revenue for what we have so far. There we go. Yeah, that's all of them. And we stretch this out as for the full amount. Oh, I forgot to put the revenue growth for memberships. Oh, sorry. Yeah, as you can see, there we go. Okay, let's move on to the 2025. It's a partial report for the first 3 quarters of the year. So we have the breakdown here. So for the 36 weeks ended on May the 11th, 2025, we've got 75,323. At the same time last year in 2024, it was 69764. So let's go E25 divided by 69764. So 1.45. So we'll do that as 75323 multiplied by 1.4543. Full thing. You don't have to do the full thing, but let's do it anyway. So when results are released in a couple of weeks, this is what we expect the revenue for this revenue segment to be 109548, and we'll do that for each of them, and we'll see how right we are when they are released. So non-foods is, we can see it was this year, the first 36 weeks, 49777. The year prior was 44301. So let's go equals E32 divided by 44301, 1.44. So it's similar to what it was for the segment before. It was a similar ratio, 1.444. So it is all looking good for Costco so far in terms of revenue growth. I mean, these are quite high so far, 12% and 8%. Fresh foods. What is that? Sorry. E39 divided by 23212, 1.47. So 25839 multiplied by 1.47423. The warehouse, E46 equals E46 divided by, no, E46, 34163, 1.46. They're all grow. I mean, they all had a similar ratio. Where are we? Warehouse, 3.4. And then membership is on the income statement, where is it? Here we go. So if we go E53 divided by 3316, we get 1.45, 359 multiplied by 1.4 there. So we expect membership revenue to go over 5 billion this year, and for total revenue to be about 275 billion, which is huge. So let's build out the projections now. We just need our boxes from above here. Actually, let's work out what each revenue segment is. As a percentage of total revenue, because particularly on the memberships and the margin, it will be quite interesting to see, because Costco, I guess, sells its products at pretty much cost, and then it makes its profit on the membership fees. So we should imagine that they're fairly similar. Almost done. Yeah, 2%. We'll see that on the net income when we get there, which I imagine it will be about 2%, and that's just from the membership fees, which are pure profit. Okay, now the first thing we do for next year's revenue growth, we'll take an average of the last 3 years, so 9%. And let's say we think this revenue segment is going to grow at 5%. By 2030, the revenue growth will be 5%. We'll put that in there. And then we put this equal to G10. And to get these figures here, we go equals the previous year, so the 2026 year, minus brackets 2026 minus the year 2030 value, so in this case 5%, divided by the final year, which is 2030, subtracted by 2026. And what we want to do is we want to lock this one in, K23, for both the cell, for the column and the row. Then for this one, we just want to lock the row in. And yeah, that needs to be, the column width should always be 10. And let's just, we'll go percentage, but we'll do 2 decimal places. Oh, there we go. And we're going to say for a bull case, we're going to say for the bull case that Costco will, let's say it will do 105% of this 5% target. And for the bear, we say it gets to 95. Costco's revenue is fairly predictable, so I think it's probably going to be around, I guess, yeah, I mean, I think it's probably a fair forecast. So we go take this cell, oh, no, sorry, we go into the one above, so this is for the bear, we go equals the base multiplied by, in this case, E10, which is the 95%. Stop changing the column width. And then we just put it down like that. And we do the same for here. And we call this it should be G28. There we go. And to get this, so that we can simulate the different scenarios of the bear, base, and bull, we go equals offset the cell that we're in, so G26, with the switch, which is up here, and we lock this in. Then we go 0 at the end, and that gives us our, and if you see, we can play about with this. See, it's changing. Yeah, then we go the previous year multiplied by 1 plus the growth rate. And there we have it. And now what we want to do is we have to do the same for all of these. So if I copy this down now, this should work. And we're going to non-foods, again, let's put 5% for now. G11, K20. Still needs to be G23, but otherwise that looks, yeah, that looks. Yeah. Oh, sorry. Sorry. You didn't see that, didn't see any of that. Just fast forward that bit and I will do it again. Apologies. We copy. Let's see if I can get it. Yeah. Then we paste. We put this one equal to G11, which is this box up here. We come down and we take here K23. It needs to be G23, which we can lock in the row, I think. That's better. And that means we should just be able to copy paste and it should update automatically on the next ones. Yeah, that looks all right. And again, I think we'll keep all of these 95% up here, and for the ball, 105. So, but it needs to be E11 here. Sorry, it needs to be E11 for this cell, and then you just bring it over. I know it's the same thing, but when you're doing the switches, it's just going to take from the first box. So if you want to simulate one segment being bear and one being bull, it's not going to be the same if you need the separate ones. Otherwise, it will just take it on the first switch. So to calculate equals offset the cell that we're in, G33. Then we want to lock in C11. We go 0. We pull it along, and we take last year multiplied by 1 plus the growth rate. And we then just pull it along. We do the same again. And let's put this as 6%. That's 12, isn't it? Yeah. Equals G12. And it needs to be E12. Yeah, all good. And we can go equal. It's better to do this one manually, or sorry, the cell we're in, G40, just so that you can just make sure it's on the right switch. Remember to lock in the C12 for the switch. And then you pull it over, and you can now actually just copy paste from above, and it will adjust the formula for you there. Yeah, so this is looking very good now. There we go. And what should we say this growth rate is going to tend to for the warehouse? Let's put 1%. And that's G13. Equals offset C13. Is that right? Yeah. Yeah, we're all good. And again, just copy from above and it will adjust nicely for you there. Perfect. Now the memberships. I think we keep a higher growth rate on this. Let's put it to 9%. Let's G14. Because Costco still has a lot of room to grow in terms of expanding internationally. We saw and we'll go through it at the end, but obviously the majority of the stores are in the US and Canada. I mean, the rest of the world has the same number of revenue as Canada does. So therefore, I mean, it just shows there's a lot of room to go there for Costco. So we'll keep it at 9% for the membership growth rate. So let's bring this down, C14. I mean, this will be huge revenue going forward. But it's not, I mean, growth has been high for the last few years. I mean, 7%, 5%, 8%, probably 8% for this year. So yeah, we're not giving it a target that it hasn't hit already. Okay, yeah, it looks good. Now we're going to go on to the income statement. Sorry, there we go, income statement. And the first line of that is always the revenue, it's always at the top. Percentage growth. We can just go equals, and to what we've already generated. We can do the same here. Easy. Then the next line is the EBIT, the operating income, and we want to know what that is as a percentage of revenue. Okay, so that's 2020. What is this one? Yeah. So this is what we want, the operating income here for 2022, for 2023, and 2024. 7793 for 2022. I mean, look at this. Revenue of 220, nearly 227 billion in revenue, and in operating income, it's making just under 8 billion. So these margins are tiny. And it's such a competitive space that you really can't, I mean, it's very hard to increase them. 8114. 81149285. And the only way really to increase your operating income is selling volume. Just keep selling more and more. 7042. Okay, so if last year it did E69 divided by 6243. Sorry. 1.487. So if we do, where is it? 7042 multiplied by 1.4872. Let's go 657. So you should do more than 10 billion in EBIT this year. Then this is just the quick forecast bit. We're going to do the actual switches for EBIT in when we do the DCF build. And you take, so to work out what the forecast is going to be, we take the average of the last few years of EBIT margin, and then we put that out for 2020, up until 2030. Then we take the revenue multiplied by the percent, by the margin, the EBIT margin. So yeah, multiplied, and that will give us, say 10.5 billion there. There we go. And the next line is taxes. And we want those as a percentage of the EBIT. So for 2022, where is it? Back onto the annual, this is the 10K. The other one is the 10Q. They come out obviously quarterly. 10K comes out annually. So 1925. So it's about 25% tax rate. 1925, 2195, and 2373. And then for 2025, it is, if they paid, so last year they did equals divided by 1614, 1.4702. No, sorry, don't do it times by that because we're going to delete it in a second. Multiply by 1.47026. There we go. And for tax rate, we just go average. There we go. The EBIT multiplied by the tax rate, and this gives us roughly what they will pay in taxes next year. And obviously it's not required for the DCF, but let's look at net income. We want that as a percentage of revenue. So net income, okay, back to the previous one, net income attributable. So 5844. So, I mean, as we were saying earlier, I mean, it's very, very small. 584, it's still 6 billion, but as a relative to the revenue, it's very small. And this net income predominantly comes from the membership sales. 6292. And then 7367. Wow, so it's a 3% net income margin. I mean, maybe even less if we were to do two decimal places. Yeah. Net income. So if they did 7367 divided by 5013, 1.47. Okay, that's that bit done. Now the cash flow items. And these include depreciation and amortization, capital expenditures, and the change in net working capital. So DNA, and we want to know what that is as a percentage of revenue. And we also want to know what it is as a percentage of CapEx. Then we have CapEx. We want to know what that is. Then we have change in net. Okay, and the figures for these line items is on this page, the cash flow statement, and we can get it from here. So 1900. And we have, yeah. Oh, it's very small. Only one pixel would be here. And CapEx is down here. Sorry, it's down here. Additions to property and equipment. So 3891. Three. And then the change in net working capital is, where are they? Changes in operating assets and liabilities. So we just add these together. Minus 4003, because it's in brackets, it means it's negative. Plus 1891. Plus 549. Equals 1228 minus 382 plus 172. When this figure is negative, it's very good for free cash flow, because you add back, you take your earnings before interest but after tax, add back in depreciation and amortization because it's a non-cash expense, subtract CapEx, and subtract change in net working capital. So if this figure is negative, two negatives make a positive, so you add it back in. And obviously if it's positive, it lowers the free cash flow. Then we have 2024 equals minus 2068 plus 1938 plus 741. And then we get this as the percentage of revenue. In these cases, though, I mean, it's going to be such a no, I think it will be significant. It's fine. Percentage. Yeah, we want to. There we go. And with these, it will actually just add in a bit more, just so that we. Just have more visibility on it. Okay, I mean, so if we take this figure divided by so we go minus 831 plus 1380 plus 417. This one's always very difficult to forecast, so I think it's best when you just do it on the annual year. One, 6, 3, 2. And yeah, okay. Oh, sorry, I'm jumping ahead of myself. 1652. Let's just work out what last year's ratio was. 2237 divided by 1531. Everything seems to be the ratio of 1.46. Throughout the whole company. Ooh. Sorry. I wonder what capex is going to be. So let's see. 4710 divided by additions to property and plant and equipment is 3133 divided by 1.5. Oh wow, it's different. We spoke too soon. 3532 multiplied by 1.50335. Perfect. Yeah, so to forecast out, we just take the average from the last few years and we find the revenue multiplied by the percentage of revenue. And we stretch that out. This is gonna be an error, but we can just copy this. Oh yeah, just always average for the last 3 years. Unless you have, well, it's not always do that, but that's what I'm doing at the moment. Multiplied by percentage of revenue. There we go. Okay, so now we build the DCF. And we're just over halfway now, so we should be able to do this. Most of it will just be copy paste. Just keep the revenue equal to revenue, percentage growth. Oh, sorry, yeah, got it, perfect. Now EBIT, we are going to need to do we need the switches for this one. So let's copy it from we don't need percentage of revenue there, but we do need it there. And so EBIT up until 2025, we just copy it along and we do the usual. Oh. Now we want our boxes so that we can simulate the different scenarios. Just get a bit more visibility on. Okay, let's put it at 3.75, the EBIT. That's, what is it, G16. Oh, perfect, yeah, it's done. Again, but this has to be oh sorry, I just fix all of these so that they're on the right line. That was my mistake. Needs to be 13. Yeah, okay, that's good. So this needs to be E16. And we know how to do this now. So we go equals the cell we're in, G96, C16, 0. Is that right? No. Oh, sorry, because I didn't put offset. Equals offset the cell we're in, G96, C16, then the 0 at the end. You have to put the 0 in, otherwise it doesn't work. No, why have I got... no, so sorry, let me just do this again. So equals offset. We're on G96. Lock it in for cell C16. There we go. Sorry about that. And now you do the revenue multiplied by the EBIT margin, and the percentage of revenue of the EBIT is basically the EBIT margin. And there we go. So we've forecast our EBIT out, and it will change as we play with the switches. So taxes is going to equal up here until 2025, and we take the percentage of EBIT there, and we copy it to here. Then we take the average, we forecast them out, and then for here we go EBIT multiplied by the tax rate. So that's going to move dynamically as and when we change the different EBIT scenarios. We're not going to do net income for here because we just want it as a rough. We don't need it for the DCF. We just wanted it if we want to do some multiple analyses at the end. Now we're going to do the EBR. So the EBR is your EBIT minus your tax payment. We just make that bold. Then we have DNA here, CapEx, and we keep them the same from what we've done in the cash flow items. Now, let's work out what the unlevered free cash flow is. Put a border in. I'll zoom in a bit now. Let me just finish typing. We can, that's better. So your unlevered free cash flow is calculated, so we go here, in for 2026. As well, before we do that, everybody just put in another row here, and make sure this goes 1, 2, 3, 4, 5. Because we need it when we use the WACC. So unlevered free cash flow now is going to equal your EBIT plus your depreciation and amortization, because it's a non-cash expense, subtract CapEx, and then subtract the change in net working capital. So we have just under 4 billion here in unlevered free cash flow. Now we want to find the present value of free cash flow. And we need our WACC. So up here, we have the WACC from the other day, which is this one. If you haven't done it, just write it in for now. And the bear case for the WACC is going to be, we do plus 0.5%. Oh. Because the higher the WACC, the more bearish you are. G. And for the bullish, we take off 0.5%. And that gives us, the range for what we think the WACC could be. To do your switches, to activate your switches, we use the choose function. And we then just put in this whole row with a comma after each cell. We just then format it. And for the terminal growth rate, we're going to go with 2.5%. And just change the signs around. So for the bullish, you want it to be plus 5% because you want a higher growth rate. And for the bearish, you want to subtract. And again, you just copy paste this down, but you use the choose function if you want to practice it, and a comma after each cell. There we go. And now we can start working out what the present value of our free cash flow is. And to do that, we take the free cash flow and we divide it by 1 plus the WACC, close brackets, to the power, and that's why I wanted us to write to the number of years. It was why I wanted to write down each year in numbers, because that way we can get the power of it. There we go. But remember, lock in your WACC. And then just pull it across, and there you have it. The present value of the future free cash flows forecasted are as follows there. Now we want to find the terminal value. We do this by taking the final year, multiplying it by 1 plus, let's just come up again. So the terminal value is this final value of unlevered free cash flow times 1 plus the WACC divided by the WACC minus the terminal growth value. And there you have it. Oops, sorry, let's pull this down. So this is what the terminal value of Costco will be. Just over, maybe about 104 billion. Now we need the present value of terminal value. Again, that's easy. It's you take the terminal value divided by 1 plus the WACC to the power, the final year, to the 5th year, And there we have it. So the present value of the terminal value is 70.5 billion. Now the next point is the enterprise value, and this is the sum of the present value of terminal value plus the present value of the free cash flow that's forecasted, and that gives us 88 or nearly 89 billion. And what we want to do is add cash and subtract debt, and that will give us what we call the equity value. So the cash for Costco is, we need to go to the balance sheet, which is usually, in orders, it usually goes income statement, balance sheet, and then cash flow statement. So Costco at the moment currently has 13.836 billion in cash and short-term investments. So yeah, these are fairly liquid. So let's put it as being 13.836 plus a billion, 1014. Plus 1014. Yeah, so about 14 and a bit billion in cash. And our debt, we know the debt from the WACC is 8.18 billion. So let's make that equal to what was in the WACC. Again, if you haven't done the previous video, just write it in now. And then, okay, so equity value is now the enterprise value plus the cash subtract debt. So 95.6 billion. And the diluted shares outstanding is, where do we find that? That's on the, here we are. So let's go 444,846 million. So 444.846. So about 445 million shares. So the implied share price equals the equity value divided by the diluted shares outstanding, and 215. So K27. Yeah, I mean, sorry, did you all see that? It was the equity value divided by the diluted shares outstanding gives us the implied share price of 215. And this one is K127. Let's come back up here. And we go equals K127. Now the upside downside, I mean, number, percentage. No, that's not right. Divided by, there we go. So if we were to, I mean, on a base case, the DCF would suggest that Costco is only worth $215 when it's actually trading at just, well, $9.50, which implies a 77% downside. But we can, yeah, so on a DCF, you'd struggle to look for a reason to buy. But one thing that we can look at is, as I mentioned earlier, the store analysis. So right now, Costco has over 600 stores in the US, over 100 in Canada, then globally, 174. So the rest of the world, has nearly as many stores as Canada, which means there's a huge room for the companies to grow, particularly in markets such as China, or Spain, France, Sweden, Iceland. Yeah, all of these could. Australia only has 15. So yeah, there is definitely room to grow, and not just on the number of stores, but in the US, the average revenue per store is about 318 million. Well, actually, no, this is up to the 3/4. So these ones I've made a mistake, but these are full year. So the average store is about 330, 320 million a year. In the US, the rest of the world, it's just over, I think it was just over 200 million when I forecast the full year. Here, I've just forecast the 3/4 to for the risk premium. I mean, if you want, we can make it just show for the ratio comparison. Where is it? Come on, come on. No, I've lost the breakdown. Here we are. What do we want to do? No. Okay, look, it's okay. I think it'll mess up on the cost of equity, so we'll leave it. But if you take the international, I think it was about maybe 220, 230 million a year. There's a lot of room to grow there, especially in these types of markets. And obviously, there's other countries that Costco can move into as well, particularly in Southeast Asia. I don't know if they've already tried there, but that's a huge burgeoning middle class. Further in Europe, but one of the things that Costco doesn't pursue growth at all costs. It makes sure it does its due diligence on where it is opening a store, whether it's domestically in the US or Canada or a new market. It does its due diligence, which usually gives it pretty much 100% chance of success when it does that. So that's where I think the growth for Costco is. In terms of their memberships, their membership revenue is growing, and this happens in two ways. It goes through getting more members, so adding members, but then also by increasing price. So those are the two levers that they've got to be able to increase revenue there. And remember, the membership revenue is pretty much pure profit. And there is a thing showing actually how many. Okay, so if you look here, Costco's got about 80 million members, which is pretty much 1% of the world. Ooh, so if you think about it, imagine, say, if they wanted to pitch Costco to a VC now, and the guy went in and he said, "Oh, if we just get 1% of the population, we'll be a $400 billion company." What's the market cap? Yeah, 400 billion. Yeah. So there's definitely room to grow in terms of number of members. In terms of if we wanted to look at a bit of a few ratios, let's go EV to revenue, price to sales. Sorry, let's go EV to EBITDA, and what was the other one? The price. So EV to revenue is on what it is trading now. We go onto the WACC, and we take the market cap plus the debt, and we divide it by this year's revenue. So trading about 1.57 times EV to revenue. Let's and the price to sales, we go market cap divided by the revenue. EV to EBITDA is, what would you call it? The market cap plus the debt again, divided, come back onto the DCF, the EBIT plus the depreciation and amortization. So, oh, sorry, there we go. So it's trading at 33.54 times EV to EBITDA, which is huge. The PE ratio is market cap divided by, where is it? We want net income. But yeah, again, look, it's 52 times earnings, and that's for the current. Let's look at what it would be for the forward. Again, we go EV plus the debt, sorry, the market cap plus the debt, divided by next year's earnings, of which we think is going to be about here. So I mean, it's getting cheaper, but not by that much. EV to EBITDA is going to be the enterprise value. You do market cap plus debt. And if we want, I mean, we're going to, at some point we can play around with it, with the switches to get the different, and it will update these dynamically as well. WACC divided by, where's net income? Sorry, there we go. Yeah. So it's not really, I mean, the multiples look like they're narrowly getting smaller as we're going forward. So it's not, I mean, this has been the story of ever since I've followed Costco for however many years. It's always traded at, well, at these levels. So even when the price was about, I remember it being, say, $300, it was like, oh no, it's still overvalued, and then it just kept going up. There seemed to be no reason based on the fundamentals of what it's currently producing for it to be valued at that level. And it is a well-run company. We can be pretty sure it's still going to be here, so maybe a couple of decades, several decades down the line. And I think the optimism is based on the fact that, again, it's a very well-run company, but also the room for growth. I think it can move into so many more territories, and the territories it's already in is very popular, and they can start having more stores. So we'll have to see how that plays out, and we'll come back to this on maybe the 26th, 27th of September once earnings have come out, and we can see where it's going. But anyway, that's all from me today. Thanks for joining in, and I'll see you on the next one. I'm thinking it could be, I don't know, maybe Lululemon for the next one. That stock's been hammered recently, so we can have a go at that one, see what it's really worth. Thank you very much. Bye.